Okay, so Thursday 21st of September, very good morning to you. Just having a look at the charts this morning, and I'm going to recap kind of just briefly what the Fed did last night, because I know some of you might not have seen the announcement in its entirety. So looking at the charts, obviously it will tell you a bit of a story of a hawkish interpretation from what the Fed delivered. And the Fed meeting last night was obviously one of the more important ones, significant in the recovery post-financial crisis, because we've now got the what you're probably going to hear termed by the press QT, not QE. So quantitative tightening is the new kind of phrase that they're coining this morning. This being then the commencement of the tightening of the balance sheet, which the Fed had given the nod was going to happen back in June. This is when they outlined the initial details about the cap, 6 billion in treasuries, 4 billion in mortgage-backed securities, and then this kind of every 3 months staggered fashion up to a 30 billion threshold of how they're going to start reducing this kind of swollen balance sheet in the wake of 3 phases of quantitative easing since 2008 and the financial crisis. So wasn't just that though. I would say that was probably largely priced in by the market, given the strategy of the Fed to start unveiling some of those details several months ago. So the market was kind of comfortable with the fact that that was going to get announced and it was going to commence as of October, and that did get confirmed last night. But as we're going to discuss, there were some other things, the projections in particular, and some of the language around the statement, meaning that the December hike is firmly on the table. And then we'll look at the trajectory of the dot plots, which meant that overall you had a hawkish reaction in the market. So as you can see, both major pairs spiking lower. The T-note bottom right lower as yields moved up, and gold saw a significant move to the downside, which I can see this morning. Technically very interesting, as it's now in the futures managed to break through with a bit more momentum that $1,300 handle early this morning. Looking at the actual charts themselves, gold was probably one of the really interesting ones, because we broke the previous day's low at the time of when the release was coming out, and then we were looking at longer time frame charts. There were a couple of good entry points, and I know some of the guys in the live room certainly managed to trade this very well as an asset. The break on that 1308, so looking at a longer time frame here, was the previous lows that we'd had defining support for the week. That then moved all the way down to that 1302 level, which was the late August low, and you can see that high that was seen in mid-August. So that was the good kind of reference point. And then actually, once it got to that 1302, that level in the futures actually matched up with 1300 in the spot price. And so when that 1300 in the spot gave way, we saw some resumed selling pressure in gold, and then it broke lower again. The next level that we were looking at, and it's played out quite well already this morning, that we were looking at last night, was this 12 kind of 97, 96 level. That was kind of the price action that held some of the movement through August, back around the 11th, and then also some of the price action from 22nd through 24th. And it's also matching up with today's, I think it's the S2 or S1 level. So technically some interesting points of entry and exit to execute this new kind of hawkish delivery and communication from the Fed. The euro was the other one. If you remember, just this week we had some ECB sources that were looking, if anything, to try and weaken the euro, given the currency pair sitting above 120. Well, Mario's caught himself a bit of a break, courtesy of Janet, and you've seen euro dollar drop quite sharply yesterday on the back of the dollar strength. We took out the 120 handle very quickly. We then also took out the weekly low, much in a similar vein to gold, and that just continued that push lower. So be interesting to see if we come back up on the intraday to that 119.72 level, which we went through quite quickly last night. If we come back up to there for the short, if there's a continuation of dollar strength, that could be quite an interesting entry point. Equities was probably the most messy, and now we've talked about this before. I know when Piers delivered the briefing on Monday, he was kind of talking about this a little bit. how equities are really not the kind of asset to focus on so much on these economic data releases or Fed speeches, because there's kind of two ways you can look at this, and I think that really defines the way in which the market moved yesterday. If I start to shorten the time frames here, we can see, this was the actual Fed reaction. Now, unlike the other assets, which held the initial move, i.e. responded to it in a hawkish way, dollar strength, higher yields, lower gold, what happened with equities actually fell initially. So if everyone's perceiving this to be hawkish, then this is a tightening of monetary policy. The net, that first reaction is one of a removal of an accommodative stance from the central bank, and this has generally then been net negative for equities, which have been helped by this low interest rate environment. However, if the Fed then, secondary thinking would be, if the Fed are confident enough to deliver tightening, then there must be improvement economically. Under the actual performance of the economy warrants tightening. And so actually then maybe these high value of corporate profitability and outlooks going forward, this record high valuations in the equity market, maybe it's supported by something more than just this monetary policy support. Maybe it's underlying fundamentals which are helping. And so then the thinking switches. And what's interesting here is that net, if you look at where we are at the moment, sitting around this pivot level of 25.02, we're really back exactly where we were pre the announcement, pretty much just a point below it. So despite the volatility, very short-lived, but it just does go to show that equities can be a little bit more tricky to trade because of this kind of two ways of looking at what this type of information means. So again, picking your asset is key when you're trading these big events. So let's have a quick recap then of the Fed in particular and talk about exactly what happened. This is kind of the headlines that Bloomberg are running this morning. Yellen brushes aside inflation mystery while Fed eyes rate hike. So essentially what the headline is suggesting, this whole idea of the Fed talking about transitory in terms of the fact that inflation, yes, it's not where we want it to be, it's not at target, but it will return to target given time. And so they're remaining confident, and therefore they can continue to pursue their strategy of tightening going forward. A couple of things here in the statement that really jumped out when the initial headlines flashed, which initially caught my eye. And this was one of them, was the statement about the weather. Because obviously there's been a lot of uncertainty about the economic impact. I'm sure you've read the stats about the monetary value of the impact and the amount of relief that's going to be needed on the Texan coast, and now obviously in the wake of Irma hitting the Florida state in the kind of southeast part of the US. So hurricanes Harvey, Irma and Maria have devastated many communities, inflicting severe hardship. Storm-related disruptions and rebuilding will affect economic activity in the near term, and this is the important part, is the secondary part of the sentence. But the past experience suggests that the storms are unlikely to materially alter the course of the national economy over the medium term. Now, there might have been those that were fearful of, how big is the impact, and how long would it take then to recover from these natural disasters? And actually, the Fed are saying we're looking beyond that. So that's definitely a hawkish way of looking at that situation. Also here, economic activity will expand at a moderate pace and labour market conditions will strengthen somewhat further. Now this is interesting because obviously the Fed are banking on the fact that actually as the labour force tightens and the employment situation, which has been fairly consistent, continues to improve, then as a net result this should then stoke demand and increase prices going forward, hence their confidence that inflation will ultimately return to target. One of the other things then, moving lower down, what did they say actually on the balance sheet side of things? Well, actually they were very brief. In October, the committee will initiate the balance sheet normalization program described in June. So actually they didn't outline any new numbers, they've already done that. And actually I'd say the commencement of this process was probably the most expected part of this event and actually wasn't that market moving. Markets already factored this in. So what was the market looking at? Well, the market was looking at these. They were looking at the table of the summary of economic projections. Now, this is when we look at things like GDP, unemployment rate, PCE inflation, core PCE, and importantly, the federal funds rate projections, or otherwise known as the dot plots, which we'll have a look at graphically in a second. Now, unemployment rate, even though she did say, I remember distinctly in the press conference that that definitely is one part of their key mandate, that's not so much the focus as far as the market is concerned about. Well, the market got quite surprised though last night, and added to this hawkish interpretation was the GDP. Because as you can see here, the top line is the latest September forecast, the one below is what we had previously back in June, and 2017 they've got much more bullish on growth prospects by the end of the year. They're suggesting 2.4% from 2.2. So if you were thinking these hurricanes then were going to have a severe ramification on the performance of the US economy, well, you thought wrong. And actually the Fed are more optimistic about where growth will be in the United States by the end of the year than they were a few months ago. It remains unchanged in 2018, but they've upgraded as well 2019. So the Fed are getting more bullish here. So obviously translating into being more hawkish in that respect. I think that did in particular catch people by surprise. The other thing was inflation. How much was inflation going to get revised down? Was a key thing that we were looking for. And actually, the first take that I saw from this PCE and the core value was, yes, it was downgraded fairly significantly for near term 2017 from 1.7 to 1.5. But the interesting thing is here, they then see basically a return back towards their previous target. So you're getting this short-term dip, but they're remaining confident that it will come back in time, back to 1.9 in the end of 2018, and then hit target by, or 2018, hit target by 2019 and beyond. The one thing I've read as well, some people suggesting then that this has kind of lowered the bar for delivery then of the December hike, so to speak. So they already have factored in it's going to be low, so therefore it is low, so there's nothing to stop them from going ahead and delivering that hike. Then you look at the actual Fed funds rate forecasts, and as you can see, absolutely no change for 2017, 2018. There were some people thinking, well, if there was going to be any maneuvering to take December off the table, then certainly you might see some changes in these particular years. However, that did not occur, so they're still on track, I believe, for 3 hikes in 2018, and then to execute the 3 for 2017, with December looking like the likely month which they'll go ahead. And then some people have looked at the fact that in the longer run, 2019, it has been downgraded as well as the longer run here, but the market's focusing on the shorter time period and this kind of hawkish reaction to the near-term unmoved dot plot change. Now, what does that look like? Well, this is what it, from a June to September comparison. The red lines defining June, the green then September, and you can see the first two remaining pretty similar. Actually, one of the main things was that there's actually now 11 policymakers see a hike for this year, up from 8 that were seen in June. So just validating even more so that the December hike is going to be coming. But then you can see these subtle changes here from 2019 and then the longer run. This is what it looks like in terms of federal funds rate futures and what we're pricing in then for a December rate hike. I spoke about this last night, if you remember, post the disappointing payrolls report we had at the very beginning of the month. The odds of a December hike were down at 30%. Well, here we are 20 days later, and prospects now are well over the 50% that were defined being priced in. We're now up at just shy of 66%. And so very much so December is a go at this point. Obviously there's things to monitor in the interim period between October, November, before we get to that actual meeting in mid-December. The one big tail risk, of course, is the debt ceiling. I think people have totally forgotten about the debt ceiling, which we were all panicking about 3 weeks ago. But don't forget, the solution that was found on Capitol Hill was for a short-term temporary kind of resolution to kick the can down the road till when? Well, actually, the US is only funded until 2 days before the December Federal Reserve meeting. So effectively, this debt ceiling issue will come right at the point of when the US Federal Reserve will need to make their decision whether or not to hike. Personally, I don't think that that's going to be an issue for the Fed, because I think ultimately these politicians, although they will look to leverage their positioning to gain as much as possible for themselves and their parties, ultimately a solution is found in the end, and so it should keep the Fed on course at that point. But something definitely as a risk to that is the only really thing at the moment, scheduled wise, that's standing in the way. Okay, a few other things I just wanted to show you this morning, a few other things to just talk about, and then we'll wrap up the briefing. One is this. Now, I saw this, I just wanted to show it. This is just an example of seasonality, and the reason it caught my eye is because the chap who puts this together has just highlighted the fact that if you look at the period we're in at the moment, that being September 19th through to the 25th, this is actually the worst part of the year in terms of the S&P's 500 performance if tracked over the last 20 years. Obviously, there's lots that could have been going on at that specific time. I don't put a great deal of weight behind these types of statistics, but I definitely do like to be aware of them. Certainly technicals and fundamentals would be the more weighted argument to make decisions from, but it's quite interesting to just see if there's any particular one day or another where the market performs well or not. Now, one thing that I saw last night, look at Boxing Day. Everyone's depressed on Christmas Eve, thinking, my God, I've just spent all that money buying my wife that new present. And then come Boxing Day, full of stuffed turkey, you're like, ah, yes, there we go. S&P up 81.8% of the time. Funny how these things work from a seasonal perspective. Moving on, let's have a look at the UK situation. And actually, I think today could be very important for the pound. Why? Because Theresa May's speech is tomorrow in Florence, of course, where she's going to outline probably her most detailed Brexit speech since, I think it was the 17th of January, when the pound had one of its biggest rallies in recent years, and that was when she outlined the 12 principles of Brexit. I think if you guys were trading at the time, you would have remembered at that point, no one really knew what Brexit was back in January of 2017. There was zero detail. Now, granted, there's not a lot more at this point, but there was absolutely nothing. She came out, very authoritative speech, detailed out various objectives that she wanted to meet, and the pound saw one of its best rallies in several years. Now, going forward to tomorrow, people are expecting tomorrow's speech to be something similar in terms of level of detail, but importantly, a concession to be made by the UK, because for the first time after going through 3 phases of talks with Europe and going nowhere, reports to be believed this week would suggest that a figure of 20 billion euros is going to be tabled as the first kind of point of conversation for settling this divorce bill to secure a transitional deal. The one important thing here, and why today is significant, is because Theresa May is meeting with her senior cabinet today. I believe it's actually happening this morning, and this obviously comes amid disruption from one of the key players within her team, Boris Johnson, who there's been reports, although he has denied them, that he said if his Brexit kind of manifesto, if you like, the 4,000-word document he released in the Telegraph for the weekend is not delivered by the Prime Minister, then he will resign. And so it'd be interesting to see how this plays out, because if the cabinet meeting is happening today, then obviously she's going to be talking to all of them, including Boris Johnson, what exactly she's going to say tomorrow in her speech. And if he's not happy about it, there is the prospect then that he could resign today. Would be interested to see how the pound really reacts to that. I would say you could probably call both sides, so you'd probably want to remain a little bit flexible, but I'd certainly be vigilant for UK political leaks coming out ahead of the speech. No doubt the fact that there's going to be about a 12-hour lag, if you like, or a 24-hour lag between her speaking to her members to then delivering the speech. Plenty of time for snippets of information to be leaked to the press, and so I would be definitely keeping an eye on the pound today. Looking at cable, actually the 135 handle managed to hold up pretty well last night. We were looking at that, of the other asset classes we talked about, gold, euro dollar, both broke their weekly low levels, which helped exacerbate some of the downside move. However, that 135 actually held in cable, despite the move lower, the support point on the 18th and 19th and the respective S1 yesterday. We've bounced about 50 pips off there, and we're pretty much sitting mid-range from that level to the pivot at 35.72. My feelings are, though, that in terms of the pound's direction then going out for the rest of this week, I actually think the pound will come out more stronger after her speech is delivered, because I think, if anything, it's going to be more favourable of getting Europe on side, because tactically, from a strategic point of view, she would want to achieve that going into the 4th round of talks with Europe, which commence next week, I believe, on Tuesday. And so this is all about tactical manoeuvring ahead of those talks to get Europe on side, so they can have some progression in those talks next week on Brexit. Something else which happened overnight, and this really wasn't too much of a market mover, but the Japanese central bank had their interest rate decision. They kept rates on hold. This is pretty much as to be expected. However, there is a new member on the Bank of Japan board. His name I have forgotten, but here it is. Gushai Takaota, or Kataoka. I need to practice my Japanese. I must admit, I am half Irish, half Chinese. That does not qualify me very well to pronounce Japanese names, unfortunately. But you had one dissenting member, and this was the new chap. So it was quite a surprise. Usually, when a new person joins a monetary policy board, like what we've seen with the Bank of England, with Ramsden, I think is the new chap, he goes with the majority because he's unwilling to kind of break that mold, wants to get his feet firmly under the table first, reevaluate the situation before making any kind of more outlying calls. But this has happened very quickly. One thing, though, for Japan, which has probably helped, and if you look at dollar yen this morning, let me just bring dollar yen into shot and we can have a quick look. So dollar yen obviously moving higher last night. This is dollar strength, nothing to do with the Japanese yen. But obviously if the Fed are talking hawkish and you've got one dissenting member in Japan who wants the complete opposite, wants more stimulus, not unwinding of it. So Japan, very much the opposite of the likes of the ECB, the Bank of England, who are also looking to the timeline shortened to have a hike, the ECB with their tapering, now the Fed with interest rate hikes and the commencement of balance sheet tightening. The Bank of Japan are the opposite. It's kind of QE to infinity and beyond at this point, with one chap suggesting then we even need to do more, make it more powerful. What does this mean then? Is that actually this is a fairly good scenario, the Fed turning hawkish for the Bank of Japan, because if dollar yen keeps moving higher, ultimately this is weakening the Japanese yen, which is more favourable for then their export-related economy in terms of the stocks that comprise of their stock index and the Nikkei. And so the weaker yen is actually a favourable dynamic for them. And so I'm sure that the Fed's decision-making will help buy them some time in that respect. Okay, wrapping up, let's have a quick look at the calendar for today. Pretty quiet this morning. I wouldn't be looking for any movement off of the public finance data out of the UK at 9:30 and the mortgage approvals. However, as I said, I would be vigilant for any kind of tweets, any news, rumours, sources circulating politically related to the cabinet meeting and May's speech tomorrow. Going into the afternoon, Just wanted to quickly mention these initial jobless claims, not because I think jobless claims are particularly important, but just so you don't get caught by surprise by an extremely high number in jobless claims. If you look at this calendar, it's expected at 300,000. The previous was 284. Now, if we start looking at jobless claims here, just wanted to show you what it looks like in the last 2 weeks, excuse me. You can see we've had a huge elevation. And if we start looking on a 10-year chart, or 5-year chart, it's probably more better to look at. This puts us back at levels at 300,000, and we've not really been at since 2015. However, why has this happened? Of course, this is all a byproduct of the weather. This is the effect that the storms have had. This was the same thing happened with Katrina many years ago, but this is just a byproduct of Harvey, Irma, and so you can expect jobless claims, the market to have factored in these increases. So the fact that it's jumping week to week, the market's not going to be spooked by that prospect. Looking elsewhere, the Philly Fed number, you've then got some monthly home price data. This is all very low down the pecking order of priority. Eurozone consumer confidence, generally speaking, doesn't really have much of a market influence either. However, from a European perspective, you do have two fairly interesting events occurring from a speaking perspective. These two. If I switch over to the ECB's media calendar, you've got Peter Pratt chairing the panel or policy panel at the ECB conference, titled, quite interestingly, Low Inflation, Lessons from the Past, Lessons for the Future. So actually this could be quite interesting, just given the fact that inflation, much like in the US, not exactly where the central bankers would like it. So it's going to be interesting to see what the take is here, and then it's read across into current context of monetary policy environment. That is coming then a bit later on. So just having a look. This is European time, so 11:30. Mario Draghi speaking after that at 3:30 European time. The President remarks at the European Systemic Risk Board. This is kind of off topic, but obviously whenever a central bank governor or president is speaking, and the fact that the text will be made immediately available, I would definitely have that marked on your calendars. So again, 10:30, 2:15, be looking out for those events. Okay guys, that's it. So going to leave it at that. Just gone through 9 o'clock. Any questions that you have, please do feel free to just message me in the chat room. Otherwise, thank you very much and have a good day.